Welcome to DeepTech315. This is where we talk about the three most important topics in tech for the week in less than 15 minutes. I'm Gene Munster along with Doug Clinton, and our three topics this week are Tesla earnings, Netflix earnings, and also why we are not in an AI bubble. And we'll kick it off with the Tesla earnings. The shares are down, call it 12% since when they just before they reported. Nasdaq's down about 3% during that time. And the reason is this was an ugly quarter and the outlook was ambiguous, which understandably why the shares are down. The company's essentially entering into what I think is going to be a year of margin pressure. And then on the opposite side of that, I think things start to improve. So let's focus in on what the key pressure point issue was here related to profitability. And this is at the center point of the whole debate around Tesla, because is this a tech company or is it a car maker? It's all about profitability. To put it in perspective is that at its peak, Tesla's gross margins, excluding credits, hit 29%. That was about a year and a half ago. And since then, they've declined to 16.3%. So investors were looking for around just under 18%, but it came in at that 16.3% mark. So that disappointment in margins really shook the stock. Investors were hoping just after the numbers came out that they would say something optimistic about margin in the future on their earnings call. Instead, they said they got a lot of pre-orders for Cybertruck, 1 million, and as they start to ramp production of that, that is also going to pressure margins. So when you put this together, the whole bull case on Tesla is related to improving margins and this being a tech company, and that just basically got stepped back a full year. Separately, there was some reading between the lines that went on relative to their outlook on demand. And there has been more talk about some of the slowdown in EVs recently. In case Musk talked about the impact of interest rates. But there was a question specifically on the call is how do they think about their 50% CAGR through 2030 related to deliveries? And Musk kind of scoffed at it, kind of laughed at the idea that you can't grow at 50% into perpetuity because you'll be greater than the size of the collective universe, something like that. But the funny part about him making fun of that is that that's a metric that he has thrown out in the past. And so that 50% delivery growth, compound growth metric gets you to about 20 million vehicles in 2030. If you adjust that to 30% growth, it gets you to 8.5 million vehicles. So that's a big step down. That's the power of compounding. And that's where the street is for next year, basically 27% growth for vehicles. And so that was the double whammy that hit Tesla this week related to profitability and separate related to the outlook longer term. I do believe that the world is going eventually to be electric. All cars will be electric. I think it's going to take longer than I initially thought. And I continue to believe that Tesla is in a great position to capitalize on that market. GM recently talked about their Orion plant, which is going to be dedicated to building light trucks. That opening, they're delaying it about a year and a half to the end of 2025. It feels like the broader automotive community is almost shifting back and embracing more toward gas-powered vehicles here. And I think that may be the current temperature. I think that eventually the tide will shift back to electrification, and I think Tesla's going to be in a great place when they do that. The 1 million Cybertruck pre-orders, probably half of them, maybe 75% of them are real. So you got to factor that in. But this is going to kind of set up for what should be some exciting movement in the story after we get through this next very tough year. So that's Tesla. We're going to shift to another earnings. That's Netflix. And they also had a big stock move, this time in the positive direction. Their shares up 17% after the day and a half after they had reported. The NASDAQ during that period has been down about 2%. The big reason why is that they surprised on the subscriber ads. They beat the estimate by 60%. And separately, they talked about a price increase. But that's not where I want to start. I want to bring Doug in here. And Doug, you and I and the Deepwater team in our daily meeting were talking about Netflix a couple days before. Fill us in what the conversation was and why it's relevant to today.
We had some skepticism, I'd say, around Netflix. We were talking a little bit about this sort of new experiential concept that they're maybe experimenting with. And we're kind of wondering, are they running out of ways to grow, basically? And I reminded the team actually that even though we don't own Netflix in any of our core funds, we do actually own Netflix in a couple of AI-powered funds that we are experimenting with. And so the machines got it right, the humans got it wrong, at least for one day with earnings. We'll see what happens over the long term. But we have been trying to use AI to see, can you use AI, generative AI, to make intelligent investment decisions over the long run? Our belief at Deepwater is if you want to understand where the world is going, you have to actually participate. You have to be curious. You have to experiment in that direction of the world. And I don't think there's any more powerful direction in terms of where the world is going right now than AI.
I love that about you, Doug. You're willing to go there, roll up the sleeves, try these different tools out, try to apply it to us, and maybe our jobs are eliminated in the future. But I guess the good news is that at least we've got our AI-powered funds here.
Hopefully our machine sustains. Yeah.
Yeah, the machines will be there behind us. Can you tell us, I know it's early, but how's the performance been?
We're just a couple of weeks in our actual application in some funds that we're running. I do have some strategies that I've been tracking for about 3 months. So kind of mid-July, we started experimenting with this. And the main first strategy that I created, it's beating its benchmark by almost 300 basis points. Right now, it's beating the S&P 500 by about 40. So far the machines have been doing pretty well.
Love it. That's going to be a fun one to continue to track. We'll definitely report back on DeepTech315 on how that progresses. And let's get back to kind of the fundamentals of Netflix. As you said, we were skeptical going into it that they've had difficulties in doing subscriber ads about a year or so ago. They made some progress in the June quarter. And then we have this kind of uptake, the lever of related to pricing. The lever related to the password crackdown is definitely working. That's why they're beating those sub numbers. And then they also talk about a pricing increase. This time it's a 9% price increase. 18 months ago it was a 7% price increase. And this is kind of a similar time window that they typically do changes to pricing about every 15 to 18 months. Happen to be 18 months in this case. And so my question goes beyond the levers. They've pulled the password lever. They've pulled the pricing lever again. They've had this ad model that they're starting to increase. The ad load's low on it today, like 8% compared to typical linear TV, which is like 35%. So this is still early. So they have some levers that they've pulled and will continue to pull. But ultimately, in the back of my mind, I keep thinking about the creator economy. And can you describe, we talk a lot about it at Deepwater, what is the creator economy and why is it relevant to the conversation with Netflix and broader Hollywood?
The creator economy is this broad ecosystem across the internet of creators, people that have 10,000 followers, 100,000 followers, even 1 million followers, and they really specialize in a specific topic. So they become material experts in some specific niche, and they build a following around it. And what's amazing about the internet is it is built for the long tail. So if you want to find a really compelling creator for almost anything that you're interested in, you can find that person online somewhere, and they're probably creating some really amazing content. I think that this creator economy, it's been an idea that's been percolating for more than a decade now. I mean, people that used to be professional YouTube creators, I think were looked down upon. And now the average full-time YouTube creator earns about $60,000 a year. So it can be a real job, a real legitimate job. And I think that that's what we're kind of seeing when we think about the attention game, that Netflix is playing, the professional content creators are playing. They're playing it against these creators because time that we spend doing leisurely things, consuming content, it all comes from the same bucket in the end of the day. So they need to find ways, Netflix does, to make sure they can keep creating compelling mainstream content that competes with this more niche content on the creator economy.
It reminds me of some comments from Netflix a couple years ago talking about the impact of TikTok on their business, and this is the creator economy as well. YouTube, at Deepwater, we estimate that hours viewed on YouTube now is 4 times what it is on Netflix. So it's definitely happening. And my question is ultimately, how does, let's say you're running Netflix here and you see this the slow rising tide of creator content continuing to grab mind share for your content consumption. What are you thinking, or what move would you pursue?
I think to try to move creators to Netflix would be a mistake, because making creators mainstream almost sort of definitionally defeats the purpose of having that niche audience. When you have hundreds of millions of subs like Netflix, you can't build a niche product that only serves 10,000 people. It just doesn't make sense. And so I would actually use another super successful creator, Mr. Beast, as maybe the model that Netflix needs to keep thinking about, which is he goes on and he creates just epic, amazing, incredible YouTube videos that millions of people do watch. He's one of the biggest, probably widespread creators in the world. I think he made $80 million, if I remember. I think I saw recently last year. So he's incredibly successful. I think that model makes more sense for Netflix. So maybe trying to figure out ways, can we incorporate maybe some of these semi-mainstream personalities? Yeah, and can we really invest in high quality content that our broad audience will really love and still be competitive alongside, the content that they're creating?
So Mr. Beast weekly kind of a...
Maybe. I mean, I don't think you can just replicate what he's doing, but I think that model makes sense, of the highest quality video you could possibly do and things that you can't find anywhere else. That's what Netflix needs to do.
Sounds amazing. And as you think about their other, give me thumbs up, thumbs down, they do talk about other growth initiatives. I think Netflix is well aware that they've got to find other things beyond passwords and pricing and ad-supported models to grow their business longer term. They talk about Netflix House, which is like a restaurant concept, still not out of the gates yet. They also talk about more live streaming content, more gaming content. What do you think about those three? Can you give me a rating, a 1 to 10 rating on each of them? And we'll start with the Netflix House, the restaurant. Are you going to grab wings at Netflix?
How about this? I'll rank them. I'll rank gaming and live streaming are really close, 1 and 2. Gaming, live streaming, and then Netflix House is like 3-4 meters below that probably.
It reminds me of like Amazon getting into brick and mortar, whether it's Whole Foods or some of their Go stores too. And is that just the pendulum? Is that we go offline with DVDs to online, and then we got to find growth, so we go back to offline?
It's fun to kind of tease about it, but I think it actually does make sense in a way for them to experiment with this experiential idea, because what they're doing, back to the idea of they're creating content, hopefully, if they're successful, that you can't find anywhere else. And, that's fundamentally how they win. And that content naturally should create worlds that people want to participate in. And how do they do that? Well, in the real world, somehow you have to have some kind of experience where you bring people together and you extend these linear sort of experiences that you have with Netflix into games, into reality, ultimately. So I think it makes sense for them to figure it out. I don't know that, the restaurant is going to be the ultimate thing, but hopefully they learn something from that they can apply to maybe another idea.
Makes sense. I'm not doing a good job of keeping an eye on the clock here. We got about 3 minutes, so if we can jump into the all-important topic of a question that, Doug, you and we get from the media frequently, which is, are we in an AI bubble?
No, I don't believe we are. I think we're in like 1996 versus the dot-com bubble, and the dot-com bubble peaked in 2000. So it gives you a sense that I think we're still really early. If you really put it to the numbers, NVIDIA trades at about 35 times forward earnings right now. And at its peak, which was just, I think, right at the end of 99, Cisco traded at around 100 times forward earnings. So Netflix is already up 200% this year. To put that into perspective, it had to be up another 200% from here to get to the Cisco level of craziness. And that same metric, that same comparison is even crazier if you look at the broader NASDAQ. NASDAQ currently is trading around 30 times. The NASDAQ in the bubble peak traded at 200 times. And so that's a 6x from here on the NASDAQ, which again has been performing really well this year. It's up almost 30%.
Why does the question even come up if we're in a bubble? Because most of us don't remember the dot-com bubble, and because NVIDIA's up a lot this year?
That's part of it. I think the move in the Magnificent Seven is probably the biggest piece of it. But I think it's also because we are at the early stages. We're at the very beginning. We're at the frost period where things are starting to percolate. But we're not at this insanity level. I think when people say we're in a bubble, it implies that we're in this totally insane, crazy period where something's going to pop in the immediate term. I don't think we're anywhere close to that. And I think that when you really think about the possibilities of AI, it's probably more profound than the internet. And so you could even make an argument we could get even crazier than what happened with the internet from here.
As we think about the work we've done for a long time together, it's always been kind of ground up, fundamental, identifying where the world's going and the companies that are going to benefit from that. And then we're talking here about a bubble, and this idea of maybe came to mind of trading. Do you trade? Do you buy a basket of companies that potentially could get caught up in a bubble and own those for the next couple of years, call it a 2-year trade? How do you think about that balance between the fundamental piece, but also maybe anticipating and wanting to benefit from a bubble that could be on the horizon?
Funny, we were talking, the analyst team and I, a little earlier about this exact topic. And I think the answer is you always want to ground yourself in owning really great fundamental companies. You should never buy a company just because you think it's going to get a bid from a bubble. That's just so unpredictable. Own great companies that not only do you think can have a great business with or without the bubble, but have the potential that if a bubble happens, they get a real insane bid. I think that's the best way to try to play anything like that if you do want to touch on the bubble theme. And then the key to playing that game is when you do get to the insanity level, when you get the Cisco at 100 times earnings and the NASDAQ at 200 times, you do have to sell because you don't want to ride it all the way up and then ride it down 70%. You've done nothing. You're basically in the same place you started, maybe even worse.
Right. That's the hard discipline, because the way the bubbles play out, the way I remember it, it's like things get crazy and you say they can't get any more crazy. And then they get more crazy, and then you say, well, it shouldn't have gotten crazier before. Now it's getting more crazy, therefore this should keep going on forever. Maybe that's the checkpoint of that second level of craziness is when you think about paring back here.
And even the hardest part of the whole thing is, even if you get it right, sensing the craziness,
right?
We still think AI is real. So let's say we get a bubble. Let's say we get a burst. Eventually you have to buy back in.
Yeah.
And that's probably
Internet was
harder
real.
than selling at the top, because then everybody just lost 70%.
Yeah, I could see a couple opportunities to create wealth around this. Makes a ton of sense. That's all the time we got today for Deep Tech 315. On behalf of Doug, Gene, and Deepwater, bye for now.